Here's the thing. We just got confirmation of something the market's been whispering about for months. Shanghai Futures Exchange dropped an announcement that changes the entire game. Starting February 28th, any participant without a hedging quota gets a zero delivery allocation on silver contracts. Not reduced, not limited, zero. That's not a rumor. That's official exchange policy. Published, documented, enforceable. When a major global exchange admits they can't guarantee delivery to non-commercial traders, that tells you everything about the physical situation underneath the paper prices. This is the kind of admission exchanges make when the alternative is worse, when letting the market see the restriction is less damaging than letting delivery failures play out in public. My name's Liam, and before we go further, let me make something very clear. I will never ask you for money. No courses, no signals, no invest with me pitches. If you see my name attached to anything like that, it's a scam. Report it immediately. I am here because markets reveal truth when you know where to look, not because I'm building a sales funnel. This is education. What you do with it is your call. Verify everything. Stay skeptical of anyone promising shortcuts or easy money. All right, let's break down what's actually happening, because the pieces are connecting in real time and the implications are massive. Silver's up another 7% in the last 12 hours. That added roughly $297 billion to its market cap. From last Friday's low of 63.90, we're now sitting 35% higher. That's a 1/3 snapback MOIS in 5 days. Think about that velocity for a second. That kind of movement doesn't happen in stable liquid markets with deep inventories and confident participants. That's the signature of something breaking underneath, of participants scrambling, of positions being forced, of market structure under stress. While that violent price action is unfolding, SHFE suspended 3 more trading groups today. That brings the total to 20 account suspensions in 7 days. Go read Article 16 of their exchange regulations. It's all public, freely accessible to anyone who wants to verify. 20 enforcement actions in a single week on a Tier 1 global futures exchange is not normal market operation. It's not random regulatory housekeeping. It signals acute stress in the system that regulators are scrambling to contain before it spreads. Now zoom out to the delivery mechanics at ComEx, because this is where theory meets reality. ComEx just saw 861,000 ounces leave the vaults yesterday, one single day. March contracts are getting rolled forward faster than usual, which is exactly what you'd expect if participants are nervous about actual delivery. If that pace holds through the end of the month, there might be enough metal to cover March delivery without a default scenario. Might. But here's the math that keeps institutional risk managers up at night. Open interest is sitting around 68,000 contracts. Each contract represents 5,000 ounces. That's 340 million ounces of paper claims outstanding. Registered silver, the actual metal sitting in vaults available for immediate delivery, is 101 million ounces. That's a 3.4 to 1 ratio. 3.5 claims for every ounce that physically exists in deliverable form. Now, not everyone stands for delivery. Most futures traders roll contracts or close positions before expiration. That's normal market function. But when stress increases, when confidence in cash settlement decreases, when participants start demanding physical, that's when coverage ratios matter. And 3.4 to 1 is not a comfortable margin when you're an exchange guaranteeing contract performance. ComEx publishes vault data daily. It's free. It's public. You don't need a Bloomberg terminal or institutional access. Just go to their website and pull the reports yourself. Don't take my word for any of this. Verify the numbers independently. Open interest also dropped by 2,000 contracts overall, which signals modest short covering activity. Not a mass exodus, not panic, but enough to show some traders are getting nervous and closing positions rather than riding them into the delivery window. That's rational behavior when you're watching vault inventories drain and exchange enforcement actions spike. Now here's where mainstream media accidentally told the truth, and it's worth paying attention to because these admissions are rare. Bloomberg just ran a story on Hong Kong gold demand ahead of Lunar New Year. Standard holiday coverage on the surface, retail buyers picking up small bars and coins as gifts, trading volumes up year over year compared to last year's holiday period. Normal seasonal pattern, right? But buried in the middle of that story, Bloomberg TV specifically reported supply constraints, especially in silver, are raising concerns about whether the momentum can last. Stop and think about what that means. Bloomberg, not some fringe blog, not a conspiracy YouTube channel, not alternative media with an agenda. Bloomberg, one of the most institutional establishment financial news organizations in the world, admitted on air that silver supply is constrained. They just didn't headline it. They didn't make it the lead. They tucked it into the narrative where most people scroll past without registering the significance. But if you're paying attention, if you understand what supply constraints mean in a market this size, that's a massive admission from institutional media that usually operates on the assumption that everything's fine, Markets are functioning normally, and there's always enough supply to meet demand at the right price. They also published a separate full-length piece on China's persistent silver squeeze. Mainstream outlets are finally catching up to what the data has been screaming for months to anyone actually tracking vault movements and exchange behavior. David Jensen just put out fresh analysis on silver depletion dynamics. His conclusion, based on vault data and lease rate movements: Western vault inventories are falling fast. Silver lease rates in the US and London are spiking, meaning the cost to borrow physical silver is rising because available supply is tight. Metal is flowing east in large quantities, responding to that Shanghai premium and Eastern demand. And crucially, all vaults globally are depleting simultaneously. Not just ComEx, not just LBMA in London, not just one exchange or one region, all of them. When you see coordinated depletion across geographically separated vaults, that tells you this isn't a local supply chain issue or a temporary logistics bottleneck. That's structural demand exceeding available supply across the entire global market. His take on volatility? Observers worried about the pace of silver's rise haven't seen anything yet. That's not hyperbole from someone trying to pump prices. That's analysis from someone tracking the same vault data, lease rates, and exchange behavior we're all watching. Go check his full work. He cites sources, he shows data, he provides receipts for every claim. Now, let's talk about the Shanghai premium, because this is where the paper pricing mechanism starts to crack in real time. As I'm recording this, Western silver spot is trading around $85.90. Futures contracts are $85.40. Shanghai spot is $89.67. Shanghai futures are $92.29. That's a 3 borrow to 77 premium per SAR between East and West for the exact same metal, same purity, same specifications, same commodity. But fundamentally different prices depending on where you're trying to take physical delivery. Check the Shanghai Futures Exchange data yourself. It updates daily. It's publicly accessible to anyone with an internet connection. That premium isn't statistical noise. It's not a temporary arbitrage opportunity that gets closed by traders moving metal between markets. It's the market telling you, in the clearest possible terms, that physical silver in the East is worth more than paper contracts in the West. And that gap has been persistent for weeks now, which means the usual arbitrage mechanisms that should close price differentials aren't functioning. Why? Because Eastern buyers are demanding delivery, not cash settlement. They want the metal in their possession, in their vaults, under their control. They're not interested in financial exposure to silver prices. They want the actual atoms. And when you want the metal, when you're willing to stand for delivery and reject cash alternatives, you pay what it costs to get it, too. That premium is the price of certainty in a market where paper promises are increasingly questioned. Let's connect this to the bigger geopolitical chess game, because none of this is happening in isolation. China's share of US imports just hit a 26-year low. 26 years. They've been systematically, deliberately decoupling from the US for 5 years straight. Not rapidly, not chaotically, but methodically. Rerouting supply chains, building alternative trade relationships, reducing dependence on dollar-denominated trade flows. The idea that the US can significantly damage China economically through tariffs on exports is increasingly disconnected from reality, when China has already spent half a decade rerouting their entire economic structure away from US dependence. They saw this coming. They prepared, they adjusted. And while decoupling economically, what is China doing on the commodity side? Export controls on strategic metals, strategic hoarding of critical materials, building that Shanghai premium I just mentioned through sustained physical demand. They're not panicking about Western sanctions or tariff threats. They're positioning for a world where physical commodities matter more than financial instruments, where real assets trump paper claims, where supply chains are weapons and resource security is national security. Here's another angle. Most market participants completely miss because they're focused on financial metrics rather than industrial fundamentals. The ratio of available silver to gold in economic terms is estimated at roughly 1 to 100. There's about 100 times as much silver as gold in terms of total above-ground supply that could theoretically come to market. But society's dependence on silver through industrial applications far exceeds gold. Gold sits in vaults. It's used in some electronics, some aerospace applications, some medical devices. But silver? Solar panels require it. Every electric vehicle has silver in the electrical systems. AI data centers use it. 5G infrastructure depends on it. Military applications consume it in quantities that don't get publicly reported, but show up in defense procurement budgets if you know where to look. All of that consumes silver at rates that new mining production can't replace. We're in a structural supply deficit, meaning global consumption exceeds new mine supply, and that deficit gets filled by above-ground inventories, which is exactly what we're watching drain in real time from exchange vaults. People aren't rotating into silver because gold got too expensive for their portfolios. They're rotating because silver's return profile is absolutely crushing gold's performance price. Right now, and anyone tracking the data can see the supply situation is objectively tighter. Gold might be tight, silver is approaching critical. Now, let me give you the institutional confusion on display right now because it's actually fascinating to watch. Bank of America just added U.S. materials stocks, and gold and silver specifically, to their list of assets showing a bubble-like behavior. They're publishing weekly updates using a new proprietary bubble risk indicator they developed, and they're actively warning clients that AI-driven innovation could fuel more unstable, bubble-prone markets going forward. So BofA is flashing bright red warning signals on metals. Bubble territory, frothy, overvalued. Clear sell signal, right? Time to take profits and rotate into safer assets. Except in the exact same week, two major Wall Street banks. Same week. Completely opposite calls on the same asset class. That tells you something critical. Institutions themselves don't know what's happening. The smart money is divided. The analysts are confused. The models are giving conflicting signals. And historically, when the big institutional players are confused, when the consensus breaks down, when half the street is screaming buy and the other half is screaming sell, that's when the biggest moves happen. That's when fortunes get made and lost. Because someone's going to be catastrophically wrong, and the market will eventually resolve that disagreement with extreme prejudice. So, which is it? Bubble or breakout? Speculative mania or fundamental repricing? Here's what the data actually shows when you step back and look at the century-long trend rather than the month-to-month noise. The S&P 500 versus gold has been in a massive 25-year bear market, down roughly 60% over more than 2 decades. And let that sink in for a moment. Think about what that means. Decades of brilliant entrepreneurs working 80-hour weeks. Technological innovation that's transformed human civilization. Productivity gains that are literally unprecedented in economic history. The greatest companies humanity has ever built. Apple, Microsoft, Google, Amazon, generating record profits, returning cash to shareholders, dominating global markets. And all of that innovation, all that productivity, all those earnings, the entire US equity market, is still underperforming a rock that sits in a vault doing absolutely nothing. No earnings, no dividends, no innovation, no productivity. Just sits there as a stored monetary claim. And it's crushing the performance of the S&P 500 over a quarter century. That's not a short-term anomaly. That's not a temporary dislocation. That's a 25-year structural trend that tells you something profound about monetary debasement, currency devaluation, and what actually preserves purchasing power over time. The S&P's earnings yield, which is just the inverse of the price-to-earnings ratio, is near 100-year lows right now. The only time it was lower? The dot-com bubble peak in 2000, right before the NASDAQ collapsed 80%. So maybe the real bubble isn't in metals. Maybe the bubble is in paper assets priced in a currency that is losing purchasing power every single year through monetary expansion, deficit spending, and debt monetization. Maybe what looks like metals going up is actually the dollar going down. And we're just watching price discovery happen in real time as participants figure out what things are actually worth in a world of unlimited fiat creation. Now here's the bearish case. Because intellectual honesty matters, and you need to hear both sides of this. Silver 1-month lease rates just dropped to 2.69% after bouncing between 4% and 6% in recent sessions. That kind of volatility in lease rates can indicate short-term position unwinding, temporary market dislocations that don't necessarily signal long-term structural shortage. Sometimes lease rates spike because of technical factors, derivatives hedging, or short-term supply chain friction that resolves quickly. March ComEx delivery might actually clear without incident if contracts keep rolling forward at the current pace. We've seen doomsday delivery scenarios predicted before that didn't materialize because enough traders closed positions, rolled to later months, or accepted cash settlement. The paper market has absorbed delivery pressure before. After the Shanghai premium at 377, while elevated and persistent, has actually been higher in previous commodity cycles. This isn't entirely unprecedented. We've seen east-west price dislocations before that eventually normalized when logistics improved or when Western sellers shipped metal east to capture the arbitrage. And BofA's bubble warning isn't meaningless propaganda from clueless analysts. They're tracking real metrics: price acceleration, volatility spikes, retail participation surges, sentiment extremes. Assets that move too far too fast can and do correct violently, regardless of underlying fundamentals. We've seen it in every market throughout financial history. Momentum reverses, corrections happen. Price can disconnect from reality in both directions, up and down, and usually does before eventually reverting. And here's the hardest truth that bulls don't want to acknowledge. There are completely legitimate scenarios where paper markets continue suppressing price for months or even years through concentrated short positions, derivatives manipulation, and coordinated central bank action. The 2020 JP Morgan settlement for $920 million proves precious metals. Manipulation is real, documented, admitted in legal proceedings. But here's what that settlement also proves, and this is the part people miss. Manipulation can persist for decades before finally breaking. JP Morgan was manipulating these markets for years. They got caught. They paid the fine. And then they went right back to the same trading desks, doing the same trades under slightly different structures. The cost of the fine was just a business expense compared to the profits from maintaining control. So, if you're expecting some imminent justice scenario where manipulation suddenly ends and free market price discovery begins, you might be waiting a very long time. Paper markets have regulatory capture, they have legal teams, they have political connections, and they have tools to suppress price that can outlast most individual traders' capital and patience. But, and this is the critical inflection point, every single one of those bearish delay factors assumes paper markets maintain control over price discovery. And that fundamental assumption is breaking down right now in ways that are becoming impossible to ignore. The SHFE delivery restrictions, starting February 28th, aren't a rumor or a temporary measure. That's permanent policy change, acknowledging they can't guarantee physical delivery to all participants. The global vault depletion isn't slowing, it's accelerating. The 20 account suspensions in 1 week aren't normal enforcement. That's crisis management. The Shanghai premium isn't closing, it's persisting and widening. Bloomberg admitting supply constraints on air is not typical coverage. That's mainstream acknowledgement of what alternative media has been reporting for months. These are all signals that physical is separating from paper. The pricing mechanism is bifurcating. The assumption that paper contracts are equivalent to physical metal is being tested, and it's failing the test in real time. You can print infinite paper contracts. Exchanges can create infinite futures. Banks can write infinite derivatives. You can leverage up synthetic exposure to any degree the regulators allow or look the other way on. But you cannot print physical metal. You can't derivative your way into more atoms. You can't fractionally reserve actual silver in a vault the way you can with dollars in a bank. And when buyers start demanding physical delivery instead of accepting cash settlement, when Eastern participants insist on metal in hand rather than promises on paper, the entire paper pricing structure breaks. Because there isn't enough physical to satisfy even a fraction of the outstanding claims if everyone demanded delivery simultaneously. That's the setup developing here. That's what these data points are telling us. We're watching the early stages of what happens when confidence in paper claims breaks down and participants demand actual physical settlement. Daniel Oliver from Mermican Capital just made a detailed public case for gold, reaching the $12,595 based on dollar collapse scenarios. His thesis is straightforward and brutally logical. The dollar's demise is mathematically unavoidable at this point, given debt trajectories and political realities. The endgame is binary. Either the government defaults on debt obligations, which destroys confidence in U.S. creditworthiness, or the Federal Reserve is ordered to buy all treasuries to prevent default, which destroys the dollar through direct monetization. There's no third option that doesn't involve either fiscal discipline that's politically impossible or economic pain that no elected official will voluntarily inflict. So we're heading toward one of those two endpoints, and both end with massive dollar devaluation. That's not fringe conspiracy theory. That's a capital manager running institutional money presenting the logical mathematical endpoint of current monetary and fiscal policy. Whether you believe his specific price target or not, whether you think it happens in 2 years or 10 years, the directional thesis is becoming harder to argue against when you actually look at debt to GDP ratios, deficit projections, entitlement obligations, and central bank balance sheets. And silver, with exploding industrial demand from energy transition technologies, monetary demand from investors seeking inflation protection, structural supply deficit from decades of underinvestment in mining, and geopolitical hoarding behavior from Eastern buyers, silver is the highest leverage play on that exact thesis. When gold moves up, silver historically moves more in percentage terms. That leverage relationship has held across multiple cycles. It's proving true again right now with a 35% recovery move in just 5 days. If gold goes to $6,000 or $12,000 or whatever the ultimate number ends up being, silver doesn't just match that percentage gain, it amplifies it. Here's what matters, right now. As we head into the final weeks of February, ComEx registered silver sits at 101 million ounces against 340 million ounces of open interest. That's your coverage ratio, your margin of safety, your buffer before the system breaks. SHFE is implementing zero lot delivery allocation for non-hedgers starting at month end. That's official exchange policy acknowledging they can't fulfill all delivery requests. Bloomberg is admitting silver supply constraints in mainstream coverage. That's institutional media catching up to reality. David Jensen is warning we haven't seen anything yet in terms of price volatility based on the depletion dynamics he's tracking. That's independent analysis, reaching the same conclusion from the same data. Wells Fargo is raising gold price targets to $6,000+ for next year, while Bank of America is warning about bubbles. That's institutional confusion playing out in real time with major banks taking opposite sides. S&P 500 earnings yield is at 100-year lows outside the dot-com bubble. That's your context for what overvalued actually means in this market. There's also a pattern worth noting that's played out for years, but is finally starting to crack. Commodities rally into U.S. market opens. Asian and European sessions bid them up overnight based on their supply-demand views. Then New York opens and systematically smashes prices back down through the U.S. trading session. That suppression pattern has been reliable enough that traders built strategies around it. But that pattern is breaking. The Shanghai premium exists because that suppression mechanism is failing. Eastern buyers are paying more for physical, regardless of what New York prints on the screen for paper contracts. The arbitrage that should close that gap, Western sellers shipping metal east to capture the premium, isn't happening at sufficient scale, which tells you either the metal isn't available to ship, or Western holders are increasingly reluctant to part with physical at current prices. Watch the SHFE delivery restrictions. Implementation starting February 28th. Watch ComEx March delivery carefully. Does it clear smoothly, or do we see stress? Watch the Shanghai Premium daily. Is it widening, narrowing, or staying persistent? Watch silver lease rate movements. Are they spiking higher or normalizing lower? These are the specific data points that will tell you whether physical is actually separating from paper in a permanent structural way, or whether this is just another volatility cycle within the same suppression regime that eventually reasserts control. Verify the SHFE announcement yourself. It's official exchange policy published on their website. Check ComEx registered vault data. It's updated daily and freely accessible. Look up the Bloomberg coverage of Hong Kong demand and their specific mention of silver supply constraints. Read Bank of America's bubble risk indicator methodology. Look at Wells Fargo's research note on gold targets. Pull the Shanghai Futures Exchange premium data. Don't trust me. Don't trust mainstream media. Don't trust alternative media. Trust primary sources. Do the work. Pull the actual reports. Verify the actual numbers. Form your own conclusions based on verifiable data, not narrative or opinion. The people who actually do that homework, who spend the hours pulling exchange reports and tracking vault inventories and reading regulatory filings, they see what's building here. They understand why 20 exchange suspensions in 1 week is significant. The people waiting for CNBC to explain all this in comfortable terms that don't challenge their existing worldview, who need institutional consensus before acting, who want mainstream validation before positioning, they'll be buying at significantly higher prices months from now, wondering why nobody warned them when it was obvious. The warning is right here. The data is public, the sources are verifiable, the analysis is transparent. The question isn't whether the information is available. The question is whether you're the type of person who checks primary sources and verifies data, or the type who dismisses uncomfortable information without actually looking at the evidence. One of those approaches leads to being positioned ahead of market moves. The other leads to confusion and regret when the moves happen and you're caught unprepared. Invest with logic, not hype. Verify everything. Trust nothing until you've checked it yourself.